The primary objective of corporate finance is straightforward. Determine whether a multi-million-dollar investment will generate a positive net present value, or NPV. Capital is allocated to projects that create wealth and withheld from those that destroy it. In practice, this decision almost entirely relies on a standard spreadsheet model. Analysts plug in their best estimates for revenues and costs, and if the final cell produces a positive base case NPV, the project gets the green light. But there is a massive mathematical blind spot here. A positive base case relies on single-point, static estimates. By treating dynamic variables as fixed numbers, this model often obscures the potential for catastrophic financial volatility. When you map that exact same spreadsheet data across a probability distribution, the true risk of the investment emerges. The project might average out to a positive return, but it hides a severe left-tail risk, meaning a high likelihood of total failure. Identifying a project's true risk profile requires moving beyond the rigid constraints of static spreadsheets and toward probabilistic engines like Monte Carlo simulations. Take the agribusiness giant Sima Darby Plantation. When they planned a major expansion into West Africa, the initial financial models produced a highly profitable base case. However, the physical reality of harvesting palm fruit in a frontier market involved variables that a static spreadsheet could not accurately price. Strategic capital allocation depends on a mathematical framework that captures the inherent uncertainty within every underlying assumption. This chart outlines the three primary pipelines required to estimate a project's cash flow over its useful life: financing, investing, and operating activities. The structural vulnerability of any financial model lies in that bottom tier, operating cash flows. These figures represent core business activities, meaning they are completely exposed to highly volatile external variables, like foreign exchange rates, local inflation spikes, and global commodity prices. Accurately forecasting a single currency exchange rate 3 weeks from now is difficult. Forecasting it across a 5, 10, or 20-year project horizon is statistically improbable. Yet traditional deterministic models require analysts to fix these dynamic, unpredictable global economic forces as rigid numbers in a cell. Treating a fluid economic reality as a static spreadsheet input creates a massive blind spot in traditional capital budgeting, leaving firms exposed to risks they haven't even measured. Analysts know their baseline assumptions are flawed, so they attempt to stress test the model using sensitivity analysis. The mechanics of sensitivity analysis are basic. You shift exactly one variable, like raising material costs by 10%, and you observe the direct impact on the final net present value. The critical flaw here is isolation. Sensitivity analysis completely ignores variable interdependencies. In the real world, inflation, commodity prices, and currency values react to one another. To account for this, corporations frequently utilize scenario analysis. Instead of testing one variable, it attempts to group multiple variables into discrete cases, usually a base, best, and worst-case scenario. But this method also fails. It attempts to map a vast, multidimensional landscape of potential economic outcomes by plotting just 3 rigid points. Relying on these standard methods creates a false sense of security. They isolate variables and limit scope, missing the compounding effect of overlapping simultaneous risks. To solve this, we return to the Sime Darby expansion in West Africa. To accurately price the risk of this frontier market, the finance team utilized a Monte Carlo simulation. They identified the 3 most volatile, interconnected variables threatening their operating cash flows: palm oil prices, foreign exchange rates, and yield variability due to climate conditions. The Monte Carlo solution replaces static spreadsheet assumptions with continuous probability distributions. Those 3 rigid inputs for prices, FX, and yield are mathematically translated into random variables, represented by probability curves. These distributions are strictly bounded by historical volatility, standard deviations, and logical limits. The software cannot pick a physical yield of less than 0. By converting rigid inputs into bounded distributions, the financial model transforms from a static ledger into a dynamic engine, capable of simulating thousands of hypothetical futures simultaneously. Here is how the simulation actually executes. The algorithm randomly samples exactly 1 value from the palm oil curve, 1 from the FX curve, and 1 from the yield curve, pulling them all at the exact same time. It runs those three specific numbers through the standard net present value equation and plots a single dot representing the outcome of that specific hypothetical reality. One iteration provides no insight. The true power of the model requires running this process thousands of times. The engine fires again and again, 10, 100, 10,000 iterations. As results accumulate, those discrete dots stack up to form a cohesive statistical shape. This final output captures the complex interrelationships of all variables, revealing the exact mathematical probability of every possible financial outcome. When Sime Darby evaluated their West African expansion using Monte Carlo data, the financial team identified a gap in their original assessment. The static base case had shown a solid profit. However, the probabilistic model revealed a significant left-tail risk hidden in the volatility of the variables. The data was stark. Despite a positive average expected return, the simulation proved the project carried a 35% probability of outright financial loss. Quantifying the specific probability removed the guesswork, forcing the board of directors to mandate risk mitigation strategies before any capital was deployed. By integrating crop insurance to protect against yield drops and securing local partnerships for FX hedging, the board reconfigured the project's risk profile. These hedges shrank the red tail, moving the entire bell curve safely to the right. Monte Carlo simulations provide the statistical resolution needed to price risk and engineer resilient corporate investments.